Before we start diving right into drawing trend lines, discussing supports, resistances, look at a theory called the Dow theory, contributed by Charles Dow. Those who have studied technical analysis know that much of the concepts of technical analysis have been derived from the Dow theory, contributed by Charles Dow. The theory is applied to stock markets, but the concepts are applicable to all markets and form the basis of technical analysis. The 6 basic tenets of the Dow theory are: the first one is that averages discount everything. Now, this is the same principle as what we have already discussed before, that the market action or price action discounts everything. Political, economic, psychological information, everything is discounted in the price action. The second tenet is that market has 3 trends: the primary trend, secondary trend, and the minor trend. We will see these trends when looking at the foreign exchange charts. Now, in brief, the theory considers the major trend to last for more than 1 year. So you're looking at a long-term trend, which is 1 to 3 years. The secondary trend represents corrections in the primary trend and usually lasts for 3 weeks to 3 months. Now, these are retrenchments of the primary trend or retraces of the primary trend, and the secondary trend could retrace to 33.33 or 50% or even 66.66%. We will look at these numbers when we look at Fibonacci numbers. The minor trend usually lasts less than 3 weeks and represents short-term fluctuations in the secondary or intermediate trend. Now, the third tenet is that major trends have 3 phases. So the 3 phases in major trends are accumulation, distribution, and speculative. The contrarians accumulate when everyone is selling and everyone is pessimistic about the economy, about the future, about the currency or stocks. That's when contrarians accumulate. Then they start distributing when no one is selling. That is during the speculative phase, when the market is overly optimistic, when it's basically a bubble. That's when the contrarian starts selling. And the fourth tenet is that the averages must confirm each other. Now here, Charles Dow meant that no important bull or bear run could take place unless all the averages, which include the industrial and rail average, also confirm with the same signal. So if the Dow average is in a bull run, then so must the industrial and the rail average confirm the same direction, which means that there should be higher peaks during bull runs and lower troughs during bear runs. The fifth tenet is that volumes must confirm the trend. This simply states that if the trend is up, it should be backed by high volumes in the same direction. If the prices move down in a bull run, then the volume should be lower in that direction. And the same with the bear run. If it's a bear run, the volume should be high when prices fall and low when prices rise. So when prices rise, it's a correction of the bear run. And the last tenet is that a trend is in effect until it has given definite signals of reversal. So this is the basis of technical analysis that we have discussed. A trend is considered to continue unless a reversal is identified. Now, identifying reversals are not easy, as we shall see when discussing reversal patterns such as failure swings, non-failure swings, head and shoulder reversals, or even when discussing oscillators that warn us of reversals in momentum. So these are the 6 basic tenets of the Dow theory, and they form much of the theory of technical analysis. And we will look at all these theories in more detail to help us trade in the foreign exchange markets. So next we will look at trends, we will look at support, resistances, and drawing of channels, speed lines, so on and so forth. This is the starting point of technical analysis.